Hi guys, it's Chad Larson. This is another episode of MLD Money Matters, Senior Portfolio Manager at MLD Wealth and part of the Canaccord Genuity Wealth Management Group here in Canada. Before I get into markets today, I want to take a moment that I genuinely mean, not as just a formality, but something I feel pretty proud of right now. Listen, to our clients and everyone who's been with us for the ride, thank you. We just recently received recognition at the Wealth Professional Awards as excellence awardees in two categories: as Advisory Team of the Year, and I took home the Advisor of the Year Alternative Investments. Those are meaningful acknowledgments, and I'm very proud of them, and I'm proud of the team. And also something I'm even more proud of, which just happened on the fund side of things. So as many of you know, I'm the portfolio manager of the MLD Core Fund. It has been recognized as the #1 tactical balance fund in Canada, not just for 1 year, but across every major rolling period: 1, 2, 3, 4, 5, and 6 years. This is not a hot streak. This is a philosophy consistently executed across multiple market cycles: bull markets, bear markets, tariff shocks, rate hikes, global pandemics, and throughout all of it, the discipline is held. So none of this happens without the trust you place in us. Managing capital is a privilege, and I don't take it lightly. And the best way we can honor that trust is to keep doing, what we've been doing, to be honest about risk, disciplined about positioning, and convicted about themes that we believe will compound wealth over the long arc. So thank you, genuinely, and let's talk about what's going on in the world. This one is going to be long. It's a lot to unpack, and in this week in particular, gave us something we've been waiting for, one of the most important earnings slates of the year, and it landed in the middle of the market that was genuinely confused about which story to believe, and we're going to walk through that here today. So segment 1, the K-shaped economy, real but misunderstood. So let me start with the concept that's been dominating this conversation among investors right now, and that's this K-shaped economy. Things that are going well and things that aren't. The concern is real. If you look at consumer balance sheet data from JP Morgan Guide to the Markets, and I use this every quarter, it's one of the most rigorous and useful documents that our industry produces. The top 20% of earners control 51% of pre-tax income. The bottom 60% are spending a higher share of their income than they're earning. Energy costs as a percentage of income hit 17% for the bottom quintile. This is a genuine squeeze on real people. Credit card delinquencies are ticking higher, auto loan delinquencies are elevated, and household debt service ratio is 11.3, which is just actually historically moderate, but for lower income households, the math is much harder. So yes, the K shape is real. Two economies running simultaneously. One group is thriving and another is treading water, falling behind. But here's where I push back on the reflexive bearish interpretation. The part of the economy that drives corporate earnings, the upper income cohorts, enterprise spending, institutional capital allocation, and the AI infrastructure build out, it's not just healthy, it is exceptionally strong. The top 20% of households have accumulated $49 trillion in net worth since 2019. Consumer spending by the top 10% of earners accounts for roughly half of all U.S. consumption. The market is not the economy, and the economy is not equally weighted. The portfolio implications of a K-shaped economy are not necessarily bearish. They're actually a reason to stay positioned where growth is concentrated, which is exactly what we're doing. So segment 2, and it's a little bit of a draconian warning, but America is all in on stocks, and it's a risk worth naming. Now, I want to lay out a statistic that I think deserves far more attention than it gets in mainstream financial media, because the single most important context for understanding where we are in the cycle: American households currently allocate 49% of their total financial assets to equities, not 49% of their investment portfolio, 49% of all financial assets. That is the highest level ever recorded in U.S. history. For context, households in Japan and the Euro area allocate roughly 13 and 10. Respectfully, Americans are all in on equities at a level 4 times the developed market average. I don't know who's left to own this, and the sensitivity to a price correction is significant at this point. And then there's what's known as the Buffett indicator, the ratio of total U.S. stock market capitalization to GDP. Warren Buffett once called it probably the best single measure of where valuations stand at any given moment. As of today, that ratio sits at approximately 227% of GDP. The lowest it's ever been was around 33% in July of 1982. Before the dot-com crash, it hit 146%. And before the '08 financial crisis, it reached 109. We are well above those levels today, and it's genuinely uncharted territory. Now, I want to be careful here because this is where nuance matters enormously. The Buffett indicator is not a market timing tool. It has a real structural bias. US companies earn significant revenues overseas. Technology companies in the S&P generate roughly half their revenue internationally. So the GDP comparison understates the true earnings base of the index. The S&P is not a domestic economy fund. It is a global revenue machine. And in a world of persistently low to moderate interest rates, higher valuations can be structurally justified to a degree. But the direction of the signal still matters. At 227% of GDP, or roughly 2.4 standard deviations above the historical average of multiple valuation frameworks, we're priced for a great deal of good news. Equities and mutual funds now account for a record share of American household net worth, surpassing pensions and home equity as the single most widely held asset class. As pension coverage has declined, ordinary Americans have taken on more direct market risk than any previous generation. The wealth effect can cut both ways. What lifted consumption on the way up can punish it on the way down. This is precisely why we currently hold over 15% cash in our MLD core strategy. Let me be direct about that decision because it sometimes generates questions. We have been outperforming every major benchmark year to date. The MLD core fund delivered 14.3% through February in a market that was down 4.3% over the same period. That performance was not achieved by swinging for the fences. It was achieved through disciplined positioning, thematic conviction, and the willingness to hold on to dry powder when the risk-reward math doesn't fully justify being deployed. Holding cash when you're outperforming is psychologically hard. The question we get is, why aren't we putting it to work? And the answer is, we are waiting for the right price on the right assets. When valuations are at all-time record levels relative to the economy, when sentiment is near generational lows, and when geopolitical backdrop is genuinely uncertain, this is not the moment to chase. That is the moment to have ammunition ready. Cash in this context isn't fear, it's optionality. And in a market where Americans have never been more concentrated in equities, being the disciplined manager who carries dry powder is arguably the most differentiated position we can hold. JP Morgan data suggests that when consumer sentiment troughs, and we're sitting at 53.3 on the University of Michigan index right now, approaching trough territory, the average forward 12-month S&P 500 return has historically been 24.1. If that optionality materializes, and we believe it will, we want to be the ones writing the checks, not the ones fully deployed at the peak concentration, hoping the music doesn't stop. Segment 3, Trump tariffs and the noise versus the signal. So now let's talk political backdrop because it's hard to ignore. It's something more than anything that I get on an almost day-to-day basis. It's, hey, I know the economy's doing good, but Trump, but the war, but Trump, but Trump. Listen, tariffs hit a statutory peak of 30% in April, the highest level since the 1940s by some measures. They've pulled back to about 12% on a weighted average basis, which is a meaningful rollback and one the market has largely processed. The trajectory matters more than any single level, and the trajectory has been toward negotiating de-escalation on multiple corridors. The Trump-Xi summit on May 14th is the next major catalyst worth watching. China is the world's largest importer of Middle Eastern crude, most of it transiting the Strait of Hormuz. That gives the U.S. real geopolitical leverage in these trade conversations, and it's a reason both sides have an incentive to stay at the table when the backdrop seems adversarial. Trade policy under this administration moves fast and unpredictably, but the underlying economic logic of engagement tends to reinsert itself. The broad market's response to all this has actually been quite disciplined. The S&P was down about 4 to 5 as late March. Given everything that's happened, is a remarkable measured reaction. Intra-year declines, I think what we're saying is it could have been a lot worse. But the intra-year decline chart going back to 1980 shows the market has experienced on average a peak to trough drawdown of about 14.2% in any given year, and still delivered positive returns 35 out of 46 years. Volatility is not the same thing as permanent impairment. But here's what I said on Bloomberg the other day, and I'll say it again here. A lot of investors are guilty of cutting their flowers and watering their weeds. They sell what's working because it's appreciated and they maybe can't justify the price to themselves anymore. And it feels good to have a win, but they hold on to what's broken because the loss feels too real to crystallize. That is the wrong reflex in this environment and one of the most consistent destroyers of long term wealth I observe in practice. Segment four, the Middle East, real risk and patient positioning. The Iran situation and the Strait of Hormuz dynamic deserve their own moment here because it's genuinely changed some of the near term thinking on international positioning. And because this week's earnings season gave us an important additional lens on how markets are processing it. The White House had announced Project Freedom, giving its guide to commercial ships through the strait, but the operational details remained unclear. Whether that includes direct naval escort, what it means for tanker insurance, whether it extends for crude carriers specifically, global energy markets remain tight and somewhat precarious as a result of this uncertainty. The practical effect on oil prices has been dramatic. Crude sitting up over 100 and well, it's 105 right now, up from the lows of 55 in December, nearly doubling in 4 months. And the ripple effects of that move are asymmetric across global markets. For our international positioning, particularly Japanese equities, this has created a meaningful headwind. Japan is a net energy importer. A sustained $100 plus oil environment is a structural negative for Japanese corporate margins and for the yen. And we've seen that reflected in performance data. Japan is about up about 1.5% US dollar terms year to date, which sounds okay until you consider we anticipated much stronger outperformance from that position in this market environment. So here's the honest read on where we stand. The conviction on this thesis has not changed. Developed markets ex-US equities trade at a discount to the US markets on a forward PE basis. That long-term average has been narrowing for legitimate reasons. European earnings have been very resilient, the defense spending cycle is genuinely structural, and the dollar's gradual weakening over 2026 creates a currency tailwind for international equities. The self-help story in Europe, particularly the aerospace and defense sector, and the continued dominance of Taiwanese technology remains intact. And I want to be direct about the tension here. AI is making a very compelling case to be a more influential factor in markets right now. We'll talk about more of this in a moment, but AI spending is accounting for roughly 40% of revenue growth across the S&P 500 this year. That's the number, and it's hard to argue with. But the real world risks from the energy situation have not gone away, and we're going to remain vigilant on both the opportunity and the risks simultaneously. So we're clear-eyed that energy is acting as a tax on the international trade right now, and we're being patient with it. The fundamentals haven't broken. The macro overlay has created a temporarily headwind, and those are two very different things. So Super Wednesday, I don't know if anyone really caught this, but what earnings just told us last week is absolutely wild. So let's get into what I consider the most important thing that's happened in markets this week and maybe this year, because it directly validates the core thesis we've been building around at MLD. Last week delivered one of the most consequential earnings slates of the year. All four major hyperscalers reported simultaneously in what's quickly been dubbed Super Wednesday. And all taken together, the results told a coherent and powerful story. AI infrastructure spending continues to accelerate. Early monetization signals are strengthening, and competitive dynamics around AI compute are beginning to shift in meaningful ways. Let me walk through some of the key companies and give you the three big takeaways. So Alphabet was the clear winner on Super Wednesday. Search revenue grew 19% to over 60 billion, with AI overviews providing additive rather than cannibalistic to query volume. That was an important data point for skeptics who thought AI search would erode Google's core business. The real standout was Google Cloud, which accelerated to 63% growth, reaching 20 billion in revenue. Saw operating margins rise, but the striking number was backlog. It nearly doubled sequentially to 460 billion. With AI products up nearly 800% year over year, they increased their capex guidance to 180 to 190 billion and flagged a further significant increase in 2027. I love to invest with certainty. Google just set the framework for what is to come over the next couple of years. This is not a company hedging its AI bets. That is a company going all in with full conviction. Meta was a little more complicated. Revenue grew modestly ahead of expectations, but Shares declined after earnings, and the reason was another $10 billion increase in capex. The core debate on Meta remains on return on invested capital. I told you it became no longer impress me with how much you spend, but can you turn this into revenue? As Meta's path to monetization is less direct, that spending goes in, but the revenue connection is harder to trace in the near term. But listen, I believe the combination of 3.6 billion users, proprietary data at scale at that magnitude, and early evidence of AI-driven improvements in content quality and ad serving gives Meta a credible path to justifying the spend. But for now, it's become a show me story. So let me give you the three things we actually learned from Super Wednesday that go beyond individual company results. The first is that AI capex is very much alive. Combined capex across the hyperscalers hit approximately 121 billion in the quarter alone, up 66% year over year, and the forward guidance is moving higher, not lower. Yes, they all updated it. But when you add it all up, hyperscaler capex guidance for the year is approximately $710 billion. To put that in perspective, that is roughly the GDP of Sweden or Argentina. That capital is being deployed into the physical world, and it is going to land somewhere. We know where it's going to land, and we own it. The second takeaway is that monetization is becoming evident. This is the key pivot point in the AI narrative, because the question marks have been asking for 2 years is, where's all this spending going in, and when does the revenue come out? And this quarter, we got meaningful early answers. Combined AWS, Azure, Google Cloud revenues accelerated 39% year over year in quarter one, the strongest combined growth rate in several years. Total cloud backlog across all major hyperscalers reached approximately 2 trillion, up 175% year over year. And Google's backlog alone nearly doubled sequentially. One of the primary concerns in the market has been that capex would outrun monetization and that we're building a bridge to nowhere. This earnings season, the revenue acceleration and backlog expansion suggests that monetization is indeed taking hold, and that the most important validation we've seen from the corporate sector since the AI build-out began. The third takeaway is a little more nuanced and directly relevant to some of the positioning decision inside alpha AI portfolios. NVIDIA did not participate in the broad equity rally that followed Super Wednesday. It actually fell 4%, and the reason matters. NVIDIA's dominance in AI compute is now facing its most credible challenge yet, and that challenge is coming from the hyperscalers themselves. Google disclosed it will begin offering custom TPU chips externally to select customers, including AI labs, capital markets firms, and high-performance computing applications. That is a meaningful strategic shift from custom silicon purely in-house. Amazon's custom silicon is also accelerating rapidly. Trainium 3 is shipping and nearly fully subscribed. Trainium 4 is still 18 months away from broad availability and is already largely reserved. Amazon's chip business has doubled its annualized revenue run rate to 20 billion. Amazon just doesn't deliver things to your house anymore, guys. And Amazon is talking about a path to 50 billion in chip revenue. Amazon was careful to note it continues to order substantial quantities of NVIDIA GPUs, but it's clear that custom silicon is gaining share of incremental AI workloads. So here's the portfolio insight from all of this. As hyperscalers pivot towards proprietary silicon, TPUs, Trainium, and whatever comes next, it doesn't erode NVIDIA's monopoly position in the data center at the margin, but critically it fuels TSMC's growth, because TSMC is the sole fabricator for both NVIDIA and all of its rivals. And this is why Taiwan Semiconductor is one of the key positions we track in the AI infrastructure space. It offers broad exposure to AI compute capacity with lower single name idiosyncratic risk. You're betting on who wins the chip war. You're betting on the fact that the war happens, and all of that ammunition gets made at the same factory. Segment 6, corporate earnings broadly and the story beneath the noise. Zooming out from Super Wednesday specifically, I want to make sure we put the broader earnings picture in context, because it's been exceptional in ways that aren't getting enough credit. Consensus earnings per share growth for the S&P 500 in 2026 is coming in around 16.6%. S&P 500 profit margins hit 14.1% in the fourth quarter of 2025, nearing all-time highs, and the composition of that earnings growth is healthy in ways that matter enormously. Margin expansion is contributing 8.9 percentage points to earnings per share growth, compared to a historical average of 2.4. Revenue is contributing 8.1 percentage points against a historical average of 5. This is not a financial engineering story. Companies are earning more on higher revenue with expanding margins. That combination is genuinely rare and genuinely powerful. The forward earnings picture is equally compelling. Consensus estimates that 2026 S&P 500 earnings at 320, climbing to 327 in 2027 and 414 in 2028. If those numbers are anywhere close to right, the valuation math on equities today looks more defensible than the headline PE suggests. And the Super Wednesday results fits perfectly into the picture. AI spending is now accounting for roughly 40% of revenue growth across the broader S&P this year. That is the most concentrated single theme contribution to index earnings growth we've ever seen in a very long time. And it means the AI trade is not a sector story anymore. It is a market story. And it's the reason why companies building power, empowering and connecting the physical AI infrastructure are not just interesting thematic bets. They are direct beneficiaries of the dominant driver of corporate America's earnings growth. Full stop. So the MLD AI portfolio, you can find about it online. I've spoken about it. It's a thematic portfolio that we launched. All of this brings me to what I want to spend some time on today, the MLD Alpha AI portfolio, and why this thesis is not just intact, but actively strengthening in light of everything we discussed. The strategy returned 12% in Q1, just over actually. The benchmark was down 0.44% in the same period. The divergence in a single quarter, albeit looks like luck, it's the direct result of building the portfolio around a specific insight that we articulated 2 years ago and have not wavered on. AI is not a software story. It is a capital expenditure supercycle that runs through the physical world. Super Wednesday validated this completely. Combined hyperscaler capex hit 121 this quarter. Full year guidance, I mentioned, it's 710 billion. Microsoft is on track to double its capacity footprint in 2 years, and every dollar of that 710 billion has to land somewhere. A semiconductor fab, a power transmission line, a natural gas pipeline, a copper mine, a cooling system, a data center building, and it's the things that we own. During Q1, we made a series of measured, deliberate adjustments to improve balance and manage concentration without changing the thesis. We trimmed applied materials and Cameco after strong runs, disciplined profit taking, not a change in conviction. We reduced Southern Copper as the position had grown relative to target weight. On the other side, we added Exelon for regulated utility exposure for power demand. Growing accelerates and expanded our Constellation Energy position for nuclear and clean power capacity, and added Williams companies for midstream natural gas flow. We also rotated from enterprise products into Kinder Morgan to better capture long-term natural gas demand tied to LNG export expansion. The Super Wednesday results also reinforce our TSMC logic. As we noticed, TSMC is the sole fabricator for both the NVIDIA and every other hyperscaler building competing custom silicone. The chip war between proprietary and merchant silicone is a tailwind for TSMC, regardless of who wins, because all roads lead through Taiwan. That's a position we understand and appreciate deeply within the infrastructure layer of the portfolio. The structure of the portfolio remains deliberate and unchanged at its core. 4 pillars: AI compute, power and utilities, natural gas infrastructure, and critical minerals. Each pillar has a decade-long demand driver behind it. Each is directly benefiting from the most significant capital spending cycle the modern economy has ever seen. And the monetization evidence of Super Wednesday matters here too. When cloud backlog reaches $2 trillion and grows 175% year over year, that means the demand for physical infrastructure that supports those cloud workloads is equally durable. Backlog is a forward order for electricity. It is a forward order for cooling capacity. It is a forward order for fiber and connectivity. It is a forward order for natural gas that powers the generators that run the data centers. That's the chain, and we own multiple links of it. Our piece from February, titled From Digital Abundance to Physical Constraint, laid out the central argument. For more than a decade, markets rewarded businesses that could scale without building much of anything. That era is shifting. As AI and digital demand accelerate, they're running into real world limits on power, infrastructure, and materials. The companies that supply those physical constraints are not beneficiaries of the narrative. They are beneficiaries of an irreducible physical necessity. You cannot run a large language model on a press release. You need electrons, you need copper, you need cooling, and you need fuel. And that's why the MLD AI portfolio is built around. And between Q1 performance and what Super Wednesday just confirmed, the thesis is executing at full speed. So, segment 8, what keeps us anchored, and some of the closing framework. Let me close with something I think is important for every investor listening to carry with them regardless of market conditions. Discipline is not a strategy you employ when things are calm. It is the thing that matters most when things are not calm. And right now, things are generally not calm. We have a K-shaped consumer economy. We have geopolitical tension in the world's most critical energy corridor. We have tariff policy that shifts week to week. We have equity valuations at historic highs relative to the underlying economy. And we have consumer sentiment near generational lows. And yet earnings are strong. Super Wednesday delivered the most compelling validation of the AI capital cycle we've seen in years. Cloud revenues are accelerating, backlog is compounding to 2 trillion. Power and infrastructure companies are translating hyperscaler spend into multi-year revenue visibility. Consumer balance sheets at the top of the income distribution are the strongest they've ever been. The labor market, while is softening, remains intact, and the Fed has room to ease if things deteriorate. This is the complexity you have to hold simultaneously, not the is it good or bad. It's both. And what matters is how you're positioned within that complexity. Our positioning reflects the following convictions. We are cautious on broad US equity index exposure at current valuations and are carrying significant cash result. We are convicted on the infrastructure of the AI economy, the physical layer, because the demand is structural. Monetization is now being validated and the supply is constrained. We are patient on international developed markets, particularly Japan and Europe, because the fundamental case is intact and the energy headwind is temporary. We are aligned with real assets and alternatives as a portfolio anchor because of the K-shaped world. Assets with scarcity value and replacement cost economics are the ones that preserve and grow wealth across cycles. The Halo framework, heavy assets, low obsolescence, high replacement costs, scarcity value remain the backbone of how we think. Whether that's pipelines, grid, infrastructure, nuclear, copper deposits, these are the assets of the digital economy cannot function without. They take years to build and that nobody is going to substitute their way out of needing. The Buffett indicator may be high, but that doesn't mean you go to cash and wait. It means you're selective. It means you're thematic. It means you carry dry powder and you own things that have intrinsic value independent of multiple expansion. And that's what we're doing. And that's what the numbers show is working. So listen, I want to close where I started with gratitude to every client who has entrusted MLD with their capital, their retirement, their family's financial future. Thank you. The recognition we received this year from Wealth Professional and the MLD Fund's core designation as the #1 tactical fund in Canada in its core category means nothing without any of you behind it. You're the reason we do this work at the level that we do. We don't manage money just to win awards. We manage money to change financial outcomes for people who trust us. The awards are a byproduct of doing that right, and we intend to keep earning their trust every single quarter. And this week reminds us why discipline matters. Super Wednesday gave us validation. The earnings data gave us confidence. The geopolitical backdrop remind us why we're carrying dry powder, and owning real assets is not a conservative posture. It's the smart one. We go into the weeks ahead with the same conviction we carried throughout, that the physical infrastructure of the AI economy is the defining investment theme of this decade. That discipline and valuation and positioning is what separates outcomes over time, and that trust our clients place in us is something we take seriously every single day. If you're a current client, you know how to reach us. If you're listening to us for the first time and want to have a conversation about what we're doing and if it's a fit for you, visit us at mywealthmanagement.ca. My book, Beyond Traditional, is available there as well. And it's the most complete articulation I've written on why alternative assets, real assets, and disciplined investment beyond belong in every serious portfolio. But until next time, I'm Chad Larson. Stay invested, stay informed, and don't cut your flowers.